Okay, 4th of April, Rudy here. The rooster suggested, we have, hope you're having a good Easter. But while his lady friends are busy providing eggs for the kids, chocolate eggs, we should do a bit of just a bit of a pause to see if our theme of the channel is correct. So we thought we'd do a video on the Australian share market and which sectors, and just have a look at a bit of history on how the charts have worked. So it's very entertaining. I'm sure you'll enjoy it. So to begin with, so the ASX share market is basically a third financials, a quarter resources, of which gold's 5%. We've got industrials, healthcare, consumer discretionary, real estate, energy and technology. Okay, so they're basically the underlying sectors that drive the share market. So we're looking at monthly charts here. So if we go back in time, just to see how the charts have worked out. So you can see we had this huge run back in the 2000s. And once we broke this trend line, it was a get out of town. Okay, then we had basically an A wave here, then consolidation. So we call that a B, and then a C wave, the same as that. So that gave us a projection of a target down here, which is in line with there. So somewhere around here, there should have been a bottom, and it broke the uptrend line. Okay, so it came up to this consolidation area and sort of formed this bottom. So now that was formed, we had a depth of the bottom, so we project that up. So that gives us the next sort of target level around here. And then we so then we formed a flag. And there's our flagpole. So you add the flagpole to the breakout. So that gave us a target level nicely there. And then we had the 2020 correction. No ABC wave, just a shit yourself wave. But that was a signal, the break of support there. Okay, so now on the way up, so we had an A wave here. So consolidation B and the C wave to there. Gave us a projection up here. Okay. So then we went into another little rounded bottom. And the depth of there gave a target price of where we got to a couple of months ago, because these are monthly charts. Okay, so where to next? Well, I think what we've got here is a bit of another. So there's our flagpole, and we'll see from the underlying sectors that we're just going to bias. So we're not going to crash, but just a biasness to choppy, very choppy, but to still end up at 10,000 over the next couple of years or whatever, in this sort of range, but choppy, and then up, and that'll be driven by a sector that we'll get to look at soon. Okay, so that's the Rooster's best thoughts. So let's look at the financial sector first, but before we do that, because the financial sector basically works off net interest margins, which is basically the difference between what they lend money at, what they charge you for the mortgage, minus what they pay you for the deposits. Okay, and generally in a rising interest rate, well, we'll get to that. So this is Australian 5-year government bond yields. So you can see we've now broken out, so we're in a rising interest rate environment now. And I've got a couple of a flagpole, or a length of the little wedge here. So a couple of target in this 6 to 7% range. So, so that's a big driver of. So this is the XFJ. So this is the banks. So I had a similar thing you can see there, but we had a. So this is our bull flag. So there's the flagpole, breakout projection, target hit, and then we just went sideways. It's actually formed a bit of a reverse head and shoulders. It's not the prettiest one, but shoulder, head, shoulder. So you take the depth and you add it to the breakout, so it gives you a target here. So we're not so we're somewhere near the top though. But the Rooster reckons we're in for one of these types of periods. And so in an increasing interest rate environment, so in the short term, the NIM increases because the banks they jack up the mortgage rates, but they're slow to pass on deposit rates, so that margin expands. But in the long term, the Rooster can see flat mortgage size growth. So we've sort of got housing prices peaking in some states. Some states are going higher, but it's run pretty hard, and with higher interest rates, people's ability to borrow is going to slow down. So he reckons that's at peak excitement, this whole thing here. So we're looking at flat interest earned, but then we're looking at increased deposit rate competition. So banks are going to fight over, come to me for 5.5 or 6 or 7 1 year. So they're going to be paying out more interest. So that's going to squeeze their margins. And if I was someone who's at retirement and you invest in the banks and get a 3% dividend, chuck on a franking credit, you might get to 5. And you can, or you can go stick it in the bank for 6 or 7% down the road, or even 5% now. You get the same income, and this thing can go all over the place, and you don't care. So that's the bank. So they're not going to detract. So there'll be a biasness to the upside, but not a lot. Okay, so the other big sector. So our materials. So materials are basically, so what we've got here is the Bloomberg Commodity Index. Now, unfortunately, it's not in the same weight as our materials sector, and we'll have a look at that. But this is a decade-long theme that's about to occur. So if we look at our materials sector, now the problem with our materials sector is basically it's overweight iron ore. So that's a shame. If we were overweight energy and copper, anyway, we deal. Well, that's why we like US based ETFs, which have different weightings, or we weight our specific global copper ETFs, etc. Okay, so how did the materials stack up? So 2008, so we take the depth of the descending triangle here, the depth, and add it to the breakout. So that got us pretty close. Okay, so then we so there's a couple of projections. So so we got one. So the flagpole could either be from here to here or here to here, and this is your flag. So you add them. So both of those give you a projection of somewhere around here, which is pretty significant growth from 45% odd over the next few years. And we had just in the short term, so we had a little mini flagpole, little flag there, breakout, so that signaled the top there of materials. So we probably just got to do a bit of this, but then eventually we'll break up to the upside. If we compare it to the XFJ, so this is materials over financials. Just go to a monthly. So what you got here is, so this is materials outperforming financials, and then vice versa. So you can see here we've got a bit of a, so this is when, around here, when it started the channel, this is when we started saying get into resources. So we've got this rounded bottom, so we've got a projected outperformance of materials over the financials, so 50% outperformance of materials over financials. Okay, now we've got the energy sector, and it only makes up 3%, as you saw, of our index, but it's looking pretty hot. I was scared to do this as a flagpole and this is a flag and project up, so I just pulled back the tone. So we've got a bit of a rounded bottom, so there's the depth, and we add it to the, well, we haven't even, you could add it to this breakout here, but technically this is waiting for this resistance to break. Anyway, we've got targets that would be somewhere around here, so you obviously want to be in energy. If we compare it to energy to materials, but get the Australian version. Okay, so this is materials outperforming energy, and I'll just go to a weekly. Well, get that fitted properly. Okay, so you can see potentially, well, energies, so it hit resistance here, so you got, this is materials outperforming energy, but there is a possibility that this maybe comes down a bit, and then energy starts outperforming materials and actually breaks that, which would be significant. It's not going to help our share market though, because it's only 3%. So, all right, then we got the gold sector. Okay, so how's he gone for historical projections? I'll just go to a month. We'll go stick to weekly. So we've got this big long bottom here. It says the depth breakout projection. So that breakout projection got us to this, well, indicated here, but we had a couple of confirming points here. So we've got another bit of a flag there with the flagpole project breakout. So we've got 2 reference points here, which signaled this as a potential topping pattern. It did for a little bit, then came down and has bounced. So we had another little flagpole and add projection, which gave us that. So now we're sort of going to be very volatile, but we've got this big flag that's forming here and this big flagpole here. So we project out, so that's implying 75% for gold. And if we look at gold over materials, So this is the gold miners over materials. So again, we've got the widest, highest, tallest part of the triangle here, the wedge, and apply it to the breakout. So you can see gold has been outperforming materials since 2024. So again, this is like this. Gold was projected at a higher rate. This is got gold outperforming the materials by 27%, which is in line with that bullish gold projection. Okay, and then so the other sort of bigger sectors is industrials. So they're just gonna blah. They'll just blah along. In the short term, there's a target down here which would be in line with support. So nothing. So no adding, no subtracting really, I don't think. And then we've got our beautiful healthcare sector, which is obviously our CSL. Go to a monthly chart. So we're out of CSL back here. Goodbye. We did try to pick some bottoms and in and out. Anyway, so healthcare does not look like it's going to rip back up. We've got a target level, and if this support level doesn't hold, then somewhere around here. So in the long run, it probably won't. It might at some stage start adding if it bounces. But in the short term, no. All right, that's the Rooster's thoughts on the Australian market. So if you want to join the channel, $10 a month. You do ASX and US shares and ETFs, and we're obviously focused in the sectors which we've just said we expect to go up. All right, enjoy your Easter. See ya.